We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. Persistently high prices are a burden for the American people. This committee will deliver price stability.
Kevin Warsh taking the podium for the first time as Fed chair after the Fed held rates steady, but more of his colleagues projecting a rate hike later this year. Warsh is already shaking up the central bank, dropping forward guidance and launching 5 task forces to review how the Fed approaches economic data. Now, the new chair is proving his independence, and President Trump is okay with that, even if he wants lower rates.
They held rates today. Did you see that?
It's all right. Whatever.
And it looks like they might even raise them later this year. It's not clear. Do you have any comment?
It could happen. I mean, it's hard to believe. It just keeps the country down, you know. So it's so unusual. But we have a very good guy over there now, so I'm guided by what he wants to do.
So we all listened to the conference, reread the entire transcript, and my colleagues were laughing at me because I said there was an AI LLM Fed model that predicted 85% chance he does not submit a dot, and indeed, he did not submit a dot. He's saying, I'm done with forward guidance. How do you think about, sort of all of the ways that he's coming in and trying to rethink the Fed?
Yeah, he's recreating it in his own image and likeness, I guess, as a normal Fed chair would. I think he had to put this message out to say, I'm explicitly independent, and create that message. And you're seeing it today. Bonds, despite the fact he was hawkish, he was clearly hawkish, bonds are up, which would imply dovishness. What that means is people are bidding it because they see that he's not a perceived puppet. The dollar is up because of the hawkishness, so it's kind of a strange response. The market doesn't perfectly know what to make of it. We're seeing a move back into the AI trade a little bit today, a little bit of confusion, but the deal helped get the market up today. So combination of all these things. I do think he's going to be a rational actor. What was surprising to the market is he kind of forgot about the other mandate of full employment. And maybe we take it for granted because we're at 4.3% unemployment. But I do think with consumer sentiment where it is and people having had real concerns about inflation expectations, with real wages, by the way, recently not growing quite as fast as inflation. So that's been an issue. I think he's trying to give comfort to the market, give comfort to Main Street. We're on it. We're acknowledging it. We're going to have a steady economy, and then over time, as we see the inflation come down with oil prices dropping, input costs dropping, then he'll be able to go about the normal business, which is to lower rates and drain liquidity at the same time by reducing the size of the balance sheet. But that wasn't the right message for day one because it would look like Trump wrote his notes.
I do not think that was hawkish at all. Okay. Absolutely not. I think that I talked to a couple of people. Chris Verone at Strategas. If you look at the yield curve, it is flattened. It is at a 52-week low. And what does that mean? It's because the two-year yield has gone up. But as you've been pointing out, as we've been talking about, the 10-year and longer-term yields have been well anchored, and they're actually, that's the 2 years. See how much it's lower today, but you see how much higher
10 basis points yesterday.
Right. So, but let's take a look at your 10-year. Your 10-year was way over 4.5. Not so much anymore. It's now well anchored below 4.5. That is actually what the Trump administration wants to see, because mortgage rates had gone up with the 10-year, but now this is telling you that inflation is anchored, is more well anchored. As I pointed out, the 5-year inflation break even has fallen sharply since the beginning of May. So your inflation expectations are anchored, and maybe the Fed hikes after the end of the year, and I say the end of the year because that's when those 5 task force complete their work. So, but for now, because the 2-year is kind of doing their job for them. And so they're on hold the rest of the year. Another reason, because all of the deeply indebted profligate borrowers, including the United States government, borrowers of questionable quality, can't afford higher, very short-term interest rates because at least a third of our debt, rolls over within 1 year. And if you raise short-term rates, then our deficit automatically gets higher because of the interest costs. So I just think that this is, according to Chris Ferrone, just a perfect scenario for the rest of the year.
I would say this. I'm going to stick to hawkish, and here's why. A flattening yield curve indicates expectations of slowing growth, because when the 10-year yield falls below the 2-year yield, you have an inversion, which basically 100 out of 100 times precedes a recession within 6 to 18 months.
It can also show that inflation is in check. Longer term,
inflation is in
longer
check.
term interest
when
rates
you're getting
are
slower growth or meaningfully slower growth. It's a sign of deflation, which is not good for the economy. So I think we're in this kind of Goldilocks. So kind of agree to disagree, but Goldilocks in terms of the economy. But what we don't want to see is we don't want to see the short end of the curve exceed the 10-year yield, because that always points to a real slowdown in the economy, and hawkish policy will create that real slowdown.
But flat is not inverted
Yet.
The good news about all of this, Brian, is the financial markets, and Kevin Warsh talked about this in response to Edward Lawrence's question, is how the financial markets should be thinking about this. And I really liked his answer. Edward Lawrence said, without forward guidance, without all these press conferences, what does this mean for American and our financial assets at home? And to me, he said it perfectly. Financial markets perform best when they react to incoming data. Financial markets are less efficient when they ask the question, how does the Federal Reserve react to that incoming information? The more that markets pay attention to what's happening in the real economy, deciding what's good data, what's less good data, the more that financial markets can price in what they believe is the most likely. Basically, I think he kind of admitted, if you get the Fed out of the way, real people in financial markets can look at the data instead of trying to front run the Fed.
Stop reading Fed tea leaves. Start looking at the economy. I love this. Did you guys see the statement that Warsh put out for this?
Bitty, bitty, bitty.
It's like all red lines of crossed out words.
Yeah.
Okay, I love it. It's not as boring as the old one. It's not filled with all the Fed jargon. And it ended with my favorite line of the whole thing. Maybe this gets to your point, Tom Hayes. He said, the committee will deliver price stability.
That's right.
He kind of is I don't know if you don't he's kind of tilting away from that dual mandate. I myself think that's a good thing. You guys ought to worry about price stability.
He has brought on an advisor who wrote extensively about that thing, a return to the single mandate of price.
Do one thing and do it well.
Here's the key contrast. Price stability for Main Street, price discovery for Wall Street.
Yeah.
What he's done by taking out the forward guidance is injected a bit more volatility in the market, because there isn't that clear forward guidance with the dots, that now the market's going to have to do it, which is in effect more capitalist.
And
what they're supposed to do.
Chris said this is a return of the central bank to not being on the side of risk takers.
I love it.
And I don't know if the actual risk takers have woken up to that yet.
Yeah.
Lydia, I will say the last question he spoke on the jobs data, but pretty much everything was on price stability. I don't want to poke too many feathers here, but Europe has the single mandate. I don't always love that we go back to what Europe's doing, but your thoughts on all this?
The jobs data, gosh, I had a different thought, but now you mentioned the jobs data. I always wonder about the jobs data, because from month to month they feel so wildly inaccurate, because we have so many revisions also, and then once a year we get like the massive revision. So I think there are just questions about the quality of that data ongoing.
There's a task force for that, don't worry.
And we're going to get to the bottom of that. Isn't that wonderful? I will throw out something here at the very end that's something that we haven't talked about that's top of my mind right now, and that is a Supreme Court decision that we're waiting, because we had Supreme Court decisions today. One of them is, President Trump's attempted termination of Lisa Cook, who's still on the board as a Federal Reserve governor.
Yeah.
What I take away from all of this is Kevin Warsh's kind of return to the data. you know, focusing on price stability, getting away from the forward guidance. That's going to protect them and insulate them from wading too far into the politics and the fiscal policy of Washington. And that's going to be the antidote to what what President Trump has started, what is now at the doorstep of the Supreme Court. That's not to say, I should also say, having covered that case, it seems like the Supreme Court is not going to allow President Trump to remove her, but we have to wait and see. But I think what we're seeing now play out is the right way to really going about correcting that the political infestation of the Fed.
Well said.